or something else, it must be equal, right? So what are the assets? Assets are economic resources or the expected future benefit, which is a finance definitions. If we learn finance, we'll talk about over there. But what do we mean by the economic resources? Economic resources which does have some value. For example, so those who already learned the economics, they know that, and we talk about the economic resources over there, that everything you do must be converted into some kind of value. For example, the services that your mom provides, they are not economic resources because mom doesn't charge it, right? If those services are charged by the, charged, or those services are provided by your maid and you pay some value in the terms of money, that is economic resources. Similarly, sunshine is not economic resource. Why? Because it is available free of cost. But the shine that you receive when you're turning off the, some tube light, some energy savers, LEDs, because you pay for utility bills and you pay money to grab those LED bulbs. So that is economic resources, right? All those economic resources that a company owns, we call these assets. Liabilities, which means outsider claims on the business, like creditors. Those who provide loans or things, we call liabilities. It means these are the claims that the company needs to pay back, right? Pay back to those that are not insiders, that are not the owners, that are outsiders, right? So the finance definition is that expected future sacrifices or expected future outflows or cost to the business. Owners equities, insiders claim, which are insiders, these are the owners of the company. It means, for example, in our previous example, if you maybe no here, right? So assets 1,000. It means company owns 1,000 worth of some assets, some economic resources. Among this 1,000, 600 worth of assets provided by outsiders and 400 provided by insiders. It means the owners contributed 400 and the liabilities that company need to pay back 600. If you convert that into percentages, it means on this company, which is worth of 1,000, 40% belongs to the owners, 60% belongs to the outsider. We call this debt or creditors or liabilities, right? It means the company 1,000. We can also say the company is financed 60% from outsider or from debt, or 40% from insider or investors or owners. Right, guys? Equation is assets is equal to liabilities plus owners equity. So the categories of the assets. So we have a little bit illustration here that what are the some of the gap incorporation we already do. Most of you guys, I think all of you guys know what is Gap. It is a fashion clothing, company. So their assets and liabilities. Cash and cash equivalents. Inventories, property, plants, and equipment. Cash and cash equivalents, we will also learn, but for example, in China, 100 yuan is cash. Cash equivalent, $100, 100 pound, or yen, or euro, right? Or gold coins. These are called cash and cash equivalents. Inventories, your stock, your finished goods that are not sold. If that are sold, that is not inventories. Okay, all the finished goods or unprocessed goods that are in the godowns or that are in the factories yet to be made, we call this inventory. And then property, plant, equipments are like AC, computers, generators, these are called equipments. Liabilities, account payable. That, for example, if somebody has paid, has like fulfilled their services and you need to pay them back, for example, salaries, wages, utility bills, right? These are all called payables. So we also have payable taxes. Why we need a separate account for this one? So that we know that how much taxes we need to pay to the company, because these are hefty amounts. So not the negligible amount, so we cannot add it to the accounts payable, right? So this is standard. Long-term debt, so all those commitments that need to pay back, and these are a nature of long-term. For example, you took a loan from somebody or from a wealthy person or from the bank, and you need to pay them, for example, for more than 1 year. 3-year loan, 5-year loan, 10 years loan, 20 years loan, right? And current portion of long-term debt, how much from the long-term debt which we took, for example, $1 million, and this year you need to pay them 1,000. 10-year loan, so every year payment is 100,000, right? That is called current portion of long-term debt, right, guys? So you can also manipulate the equation. So we already know that assets is equal to liabilities plus owner's equity, right? So if we want to find out the owner's equity, how we can find out? Owner's equity is equal to assets minus liability. If we want to find out liabilities, so liabilities is equal to assets minus owner's equity, right? You can rearrange the equation, you can find out the relevant figure. Simple. So owner's equity can be calculated as assets minus liabilities is equal to owner's equity. Rearrange the formula, that's it. So now let's define the owner's equity. Owner's equity consists of two stuff: paid in capital plus retained earnings. Retained earning plus paid in capital. What does it mean? Paid in capital, it is the common stock, the amount that you invested in the business. For example, you bought a shares, how much you value you bought the share, that is your paid in capital, right? The amount stockholders have invested in the corporation is called paid in capital. One share is 30 rupees and you bought 1,000 shares. So paid in capital would be $30,000, right? Retained earnings. So pay attention to the word retained and then earnings. So it means if company make a profit, so company have option either to distribute 100% or distribute some and retained it. A smart move is that why to distribute all of the profit and in future we go to the bank and take a loan. Why not we retain all the earnings and use that earnings for the business expansion, right? If we take a loan, we need to pay interest. Sorry about my writing here. Interest. If you make an earning of 10,000, why my pen is not still working properly? Okay. If $1 million you make a profit, and you know that next year we would be replacing our plant, or we would be expanding our business, and we need $1 million as well. And we take $1 million, we need to pay 10% interest. So in next year, we would be paying 10,000 as interest expense, which is the outflow. It means our profit next year going to be decreased from 10,000 as interest is the expense, the interest is the outflow, right? So smart move is that if we make a $1 million, we do not distribute to our owners. We excuse them today. This year we say that we are not paying you, distributing our profit. We will be investing that in future expansion. So this is a smart move. So we call this that we have not distributed our profit, we have retained it. So that earning, that profit belongs to outsider? No. That profit belongs to stockholders or shareholder, right? So that's why we call this common stock plus retained earning. Understand, guys? Kathleen, Joanne, Husong, Claude,
Understand?
Lotte,
Yeah.
Fabian, Ali,
Yes.
Bijodi, Coco,
Yep.
right? Florian? Good. Well done, guys. So, like I told you, retain earnings. How can we find out the earnings? Similarly, your revenue minus expenses, we got profit, and minus how much we distribute, we call this dividend. So that is called retained earning. So it means revenue or your sales belongs to retained earning. Expense belongs to retained earning. Why? Because revenue minus expense minus dividend, you will find out retained earning. So your dividend also belongs to retained earning, and retained earning is a part of stockholder equity. So basically what we are trying to say here, let me explain you. So we are discussing owner's equity. Owner's equity consists of paid in capital and retained earnings. How retained earning is calculated? Number one, revenue minus expenses